Coming up in this week's episode, we're going to be taking a look at the latest lender rate changes. We're going to be looking at the latest lender criteria changes. And after a very interesting week in the mortgage market, we're going to be diving a little bit deeper into the swap rate chart, what that means for mortgage rates in the coming weeks. Hello everybody, and welcome to the UK Mortgage Market Insights for the week ending the 23rd of February 2024. I hope I find you all well. There's not been a huge amount of economic data released this week, but what has been interesting is what's been happening with mortgage rates. So in this week's episode, we are going to delve a little bit deeper into the swap rate chart and look at what is happening with mortgage rates and potentially what's going to happen with mortgage rates going forwards. But first up, let's take a look at those lenders that have changed their criteria this week. And they include the Skipton Building Society. They've improved their minimum value for non-standard flats outside of the London area, increasing them from 100,000 to 150,000. Accord have made improvements to their new build affordability criteria. And Metro Bank are making improvements to their joint borrower sole proprietor mortgage criteria, with changes such as your joint borrower is now able to reside in the property with you. Your joint borrower can now actually provide a gift and reside in the property where they couldn't previously. And non-relatives can also be a joint borrower. So some good improvements to the joint borrower sole proprietor criteria, because that mortgage is proving to be more and more popular in recent times. Now, there have been other lenders that have changed criteria, but nothing that's overly groundbreaking, so I'm not going to report on that because there's been a lot of changes in lender rates, which I want to come on to next. So this week has been absolute carnage for mortgage rates, with lenders withdrawing their rates from the market at short notice and actually increasing them. So let's take a look at the lender rate changes. So first up, we've got Generation Home. They made rate reductions on some of their 90 and 95% products, but then made some rate increases on their home buyer products. Accord, new buy-to-let business fixed rates are increasing in nearly all areas and also in the buy-to-let product transfer range. Skipton Building Society have made increases in many of their fixed rate products. Santander have also made increases for their new business and existing customer rates. The Bank of Ireland have increased their product transfer rates, and Coventry Building Society are increasing all their rates for both new and existing borrowers. HSBC with a big one this week, all of their rates have increased, and Atom Bank have also increased all of their rates. NatWest are increasing rates for purchases, remortgages and existing customers by up to 0.2%. Leeds Building Society have launched some new products, but selected rates for existing customers are also increasing, and Virgin are increasing their broker exclusive rates and also their product transfer rates. So as you can see, across the board, all lenders have increased their rates this week, which means that getting a mortgage is proving a little bit temperamental at the moment because you have to move very, very quickly in order to secure the rate that you're looking for. As a complete outlier to all of this negative news, yesterday Halifax announced that they were actually going to be reducing their mortgage rate, also along with their Birmingham Midshires brand. Now, yesterday I was asked by the Evening Standard for my thoughts and comments on this, and as you can see on screen, I stated that the move by the Halifax stands out like a sore thumb. Every other lender has been increasing their rates this week, and then the Halifax come out and announce that they're reducing rates. Now, I just want to explain a little bit about this because, in my opinion, this is the Halifax screaming that they actually need to write some business, because what you'll find in the mortgage market is that many lenders will price themselves in such a way that they actually get more mortgage business. And when they start to hit their target levels, what they'll tend to do is they'll remove their mortgage rates from the market and they'll increase them so they don't get as much business, and that means that the next lender that was the cheapest moves to the top of the list, and then they're the ones that start to get all of the business. Now, of late, Halifax haven't been priced very well. They haven't really been coming up on the rate charts. So this to me is saying that, look, we haven't written much business so far this year. Whilst everyone else is increasing their rates, let's take advantage of it and let's reduce ours. Now, at this point in time, we don't know what those rates are going to be, but the one thing that I will say is that we do hope that they're not ambitiously priced and that actually, yes, they come in a bit cheaper than other lenders, but that the Halifax can actually hold these rates there for some time, because a lot of the other lenders that have been pricing competitively, their rates have only been available in some cases for a matter of days before getting increased again. So kudos to the Halifax for reducing rates, but please, if anyone from the Halifax is listening, please keep them on the market for some time, because as brokers, it's very, very difficult having to navigate talking with customers, quoting them for mortgages, and then finding out at very short notice that those products that we've been quoting on are getting removed, and before you know it, the client is out of pocket and having to choose a higher rate, costing them more money. So please, Halifax, if anyone's listening, please do the right thing and keep your rates on the market for some time. So moving on to the latest swap rate chart, what I've decided to do is bring this up on screen and talk you through just some of the information that we're seeing live so that you can get a little bit of an understanding of what we think is happening with mortgage rates. So as we're looking on screen, what you can see here is the latest swap rate chart from yesterday. Now, this, as you can see in the box, when I bring this box up, you can see it says 22nd of February. This is because the markets are not going to open until 8 o'clock this morning. So this is the latest information that we've got is from close of business yesterday. This chart goes right back to August 2022. You can see the fluctuations in the swap rates over that period of time. And as you can see, they go up, then they come back down, they stabilize for a bit, making slight increases over a period of time, going back up to a high point in the middle of June last year. Then they started to come back down again, reaching a low point at the end of December, which is when we were starting to say things are looking really good in the mortgage market and we're hoping that rates are going to improve. And indeed they were. That's why we were seeing lenders reducing their rates, which was fantastic news. However, then out comes inflation data, employment data, wage data, and all of these things, along with comments from the Bank of England saying that actually we think we might need to keep interest rates higher for a little bit longer, whereas previous expectations were that the first Bank of England base rate cut might come in May time. They're now saying, actually, we think it could be June, perhaps even later. And that's why we've seen the swap rates, as you can see, steadily increasing over time, and why yesterday was absolute turmoil in the mortgage market and with all lenders increasing their rates. Now, at the top of the chart, you can see what the latest swap rate is for any relevant year and how much it changed in yesterday's market. And then at the bottom, you can also see from the data that's on screen, the lowest point of that particular swap rate, the highest point of that particular swap rate, and the average for that particular swap rate as well. Now, what's really interesting is the forward curve. So if I just flick onto the next screen, you can see here what is potentially going to happen with swap rates. This is the 3-month swap rate. So it's a very, very short-term view, but it does give you a bit of an indication on what we think is going to happen with rates. So as you can see, the 3-month swap rate potentially going to hit a peak at 5.3%, and then it's going to make a steady decrease. And as you can see along the bottom on the timeline, we're going from February 2024 right through to February 2034. Now, obviously, what actually is going to happen with interest rates is not really known by anybody, because at the end of the day, the rate charts that we look at are all speculation. So the reason we were seeing interest rates decreasing was because traders and the market were expecting that the Bank of England were going to reduce the base rate quicker than expected. However, it's proven that they potentially got that wrong, because Andrew Bailey has come out and said, actually, we might keep them higher for longer. Hence, we're now seeing the rates increase. Now, I have been talking to quite a lot of customers lately who've been saying, well, why don't we just choose a tracker mortgage? One that's flexible, one that has no redemption penalties, and then when rates come down to a suitable level, we can just switch on to a new fixed rate and there's no worries. The problem is that the tracker mortgages right now are priced roughly 1% above the next lowest 2-year fixed rate. Now, I was listening to some comments yesterday, and there were originally expectations that we might see 4 or maybe more base rate cuts this year. The thought is that that might now be 3, or it could even be less. So if you went for a tracker product right now that's 1% higher than the cheapest fixed rate, you could find yourself paying over the odds for a considerable length of time just to buy yourself some flexibility. Does that really make financial sense? In my opinion, it doesn't. But obviously, everybody's circumstances are individual, and what's right for one person isn't necessarily right for another. So it is important to take advice from qualified professionals that monitor the markets just like we're doing here. So I hope you found this little bit of a deep dive into swap rates and the markets useful when it comes to your decision-making process if you're looking for a mortgage. Now, if you're a regular follower of the channel, you will know that we do produce this weekly update video every Friday. I am also on Instagram at LodestoneMP, and I do produce daily content on there with quick snapshots of market rate changes, lender rate changes, any key economic data. So if you do want to be kept completely up to date with hot off the press news, please do go give me a follow on Instagram, like I said, at LodestoneMP. But in the meantime, I do appreciate your support on this channel, so thank you for watching and thank you for following. If you don't already, please do consider subscribing and show your support in the channel. It is really appreciated. I do also like interacting with you, so please, any thoughts, feelings, comments on the video, please do leave them in the comment section below. And if you've got anything that you'd like us to cover in future videos, again, please let us know and we'll do our best to try and help you out with that. Once again, thanks for watching and thanks for your support. I hope you have a great weekend, and I'll see you next week. Take care.